Welcome to the International Accounting. Remember to subscribe the channel, like. Employees, increase efficiency, close down production lines. 2. Use budgeting methods such as incremental budgeting, zero-based, rolling, continuous, activity-based, performance-based. 3. Consolidate budgets from departments. The budget plans of each department will be compiled to give a feasible view from the eyes of each department and compared with the overall goal of the business. 4. Budget review adjustment, based on the set goals and the current situation of the business. The budget will be adjusted in the most feasible direction. Budget items that are less likely to contribute to the goal will be cut to optimize resources. 5. Budget approval and allocation. The budget, once planned, will be described and divided into smaller plans for each department to implement. 6. Monitor and evaluate performance. The director and department heads will continuously collect information on budget usage and effectiveness to continue to evaluate the budget plan. Make appropriate adjustments when allocated resources do not bring about the expected results towards the objectives. Depending on the goals and development of the business, we set up operating budgets by month, quarter, and year. Depending on the plan, we calculate the budget targets as follows. 1. Sales revenue include sales of goods, sales of service, sales of finished goods. The sales department, depending on the actual situation, depending on the goals and development of the business, can forecast revenue for the next month, quarter, or year. This revenue must be approved by the director with the participation of the accounting department and, of course, must be feasible. 2. After having a revenue plan, the budget is allocated to departments such as production, purchasing, accounting, and human resources to prepare for the implementation of the plan. Departments must set up budgets for their departments. The production department, manufacturing company, calculates how many workers are needed, how much, how many machines, tools, and equipment are needed. The purchasing department must buy how many raw materials or goods to prepare for production and purchasing. The accounting and finance departments must see how much money to spend and how much money to collect in the future. The human resources department must recruit how many workers, how much salary must be paid for the upcoming plan. After the departments calculate the budgets their departments need, they give it to the accounting and finance department to synthesize and set up a budget for business operations. Calculate variable and fixed costs. Large commodity variables include raw materials, finished goods that you use to manufacture or sell. Salary, just the salary paid to workers who are directly involved in the production, shipping costs, and costs associated with the transport of raw materials and finished products. Other variables. Fixed costs include salary for employees in Offices and shops, rent a factory or rent an office, monthly payment for public services such as electricity, heaters, water, the cost of the building's regular maintenance or repair, cleaning costs, petrol vehicle cost, vehicle allowance, business fee, fixed telephone expenses in the office, postage stamps, postal fees, computer network, mobile phone charges, internet rental costs, subscription or website management and upgrade fees. Expenses for marketing and advertising, meeting costs, expenses for technical documents, insurance fees, subscription costs, costs for courses, computer equipment, rent. A factory or long-term office, miscellaneous shopping, periodic maintenance work, salary for accountants, pay attorneys' fees, payments for other consulting services, estimated additional cost 5%. 3. Results before calculating interest and deduction. Depreciation equals sales revenue minus total cost, variables, fixed. 4. Interest include bank interest rates payable on bank overdraft debts, other interest payments. 5. Depreciation and deduction include factory or machine, car, truck. 6. Profit, gross profit minus fixed cost minus interest and depreciation. Results before calculating interest and deduction, depreciation minus interest minus depreciation and deduction. Notes: raw material costs are calculated based on standards, commissions are based on sales, shipping costs are based on volume or quantity of goods. Salaries and insurance costs are based on the previous month's payroll, plus or minus the business plan, such as recruiting or firing employees according to plan. Rent for factories, offices, cars, machinery, and consulting lawyers depends on the monthly, quarterly, and annual rental contracts. Office supplies, personal phones, and telephone costs are based on the business's standards. Cleaning and sanitation costs depend on the school month or the average of the last 3 months. Electricity costs depend on the previous month or additional adjustments to the business's production and business plan and the price increases or decreases of the electricity supplier. Office and factory equipment depend on the business's policy. Marketing cost, interest depends on the development policy of the business. In short, cost calculation is based on standards, contracts, and business needs. Let's start by looking at the operating budget table in detail. This is a sample operating budget form that includes the following columns. Items. The plan column can be monthly, quarterly, or yearly depending on the company's policy. In the items column, there are important indicators such as sales revenue, sales of goods, sales of service, sales of finished goods, total sales. Charge commodity variables are used including raw materials, finished goods, salary, just the salary paid to workers who are directly involved in the production, shipping costs, and costs associated. Other variables. Charge commodity variables are used. Gross profits, sales, revenue minus variables. Charge commodity variables are used. Contribution rate, gross profits as a percentage. Fixed costs including salary for employees in offices and shops. Rent a factory or rent an office. Monthly payment for public services such as electricity, heaters, water. The cost of the building's regular maintenance or repair. Cleaning costs, cleaning. Petrol vehicle cost, vehicle allowance. Business fee. Fixed telephone expenses in the office. Postage stamps, postal fees. Computer network. Mobile phone charges. Internet rental costs. Subscription or website management and upgrade fees. Expenses for marketing and advertising. Meeting costs. Expenses for technical documents. Insurance fees. Subscription costs. Costs for courses. Computer equipment. Rent a factory or long-term office. Miscellaneous shopping. Periodic maintenance work. Salary for accountants. Pay attorneys' fees. Payments for other consulting services. Estimated additional cost 5%. Total fixed costs is the sum of all fixed costs above. Then we calculate the performance results. Results before calculating interest and deduction, depreciation equals sales, revenue minus variable minus total fixed costs. We calculate the interest rate, meeting costs, bank interest rates payable on bank debts, other interest payments, total interest, deductions, depreciation, factory or machine. Total deduction, depreciation. We calculate the difference between fixed cost and interest and depreciation. The result is profit, gross profit minus fixed cost minus interest and depreciation. This is the final result of the operating budget that the business wants. However, we must make a periodic payment plan to adjust the budget effectively. Thank you for watching our channel. See you again in the